Hey everyone, and welcome back to Option Alpha. It is Tuesday, December 28th here. Welcome back from the holiday break that we had, the nice 3-day trading weekend. Hope everyone had a very safe and happy holidays. It's really good to be back. It's going to be a pretty slow week for the markets until we kick off the new year, and then things will really start ramping up again. But I did want to highlight a couple different things and try to, talk about some other things other than the obvious mistakes that are being made at Thinkorswim with the margin requirements today that have completely ticked me off, to be quite honest. Anyways, I spent most of the day dealing with that when I should have been dealing with other things that are far more important. Okay, so I think something to look at, generally speaking, and I'm going to harp on this a couple times tonight, is the overall bullish sentiment that's in the market. And this is a chart from the Investors Intelligence survey of bullish sentiment in the market. And you can see on this chart, the average is right below 90 bullish percent sentiment. And right now we are touching the or close to the 130 mark combined bullish sentiment. So it's overly bullish. And really, the last time that we saw numbers, I mean, really up in this stratosphere were in 2000, and then in 2004 a couple times, and then back again right before 2005. So I think it's safe to say that regardless of where the market is, not trying to pick this trend apart from the high side now, get out of your longs. If anything, you're much better off being short net as we head into the new year. I think that's going to be a lot better trade overall. If you look at a chart actually of the S&P, and here's the S&P right now, you can actually see that the last 18 days or so of trading, only 3 have been down days. And that's pretty impressive. That's really impressive mark for December, really, and one of the better Decembers that we've seen on record. Now, of course, this doesn't mean that this is just going to continue on forever. We know that the odds are heavily favored in the bearish side now, and really the market hasn't really made leaps and bounds like it did when it started this rally back in early December. It's kind of definitely tailed off. It's only made about a 30-point move here in the latter half of December, whereas in the beginning of December it made almost, a 50-point move, if you want to call it that, heading into the early part. So it's definitely tapered back. It's moving slowly higher, but not really knocking anyone's socks off leaps and bounds. The other thing that I want to take a look at again here tonight is the VIX, as always, continues to move lower. We had a little spike higher on Monday, but today just continued to move lower. So anything below 20 is just really, really too low. I think what's interesting about the VIX technically is that we seem to be hitting this support or resistance region right here around 18. You can see it bounced off of it numerous times in October, November, and then again in early December. Now that it's broken below that level, it's hit its head against that level twice now. So I think that if we get back up above 18, it could definitely run and make a run towards the upper or lower 20s here very, very soon in the near future. The other thing I want to take a look at is commodities, and particularly oil. Now, I've drawn this line on oil, and it's been my trend line for a long time now on crude oil here. And it seems like we're just continuing higher, but we continue higher underneath this trend line, which really kind of not scares me, but just shows me that crude may not be as strong as we all think. Now, I know a lot of people are estimating that crude will be up in the hundreds in early January, February. And I think that there's definitely some validity to it. I don't think that it's going to be rallying up to 105 and 110 anytime soon. But I definitely think 95 to 100 is a good range for crude as we head into the hard winter months here in the northern part of the hemisphere. But I do think that there is some weakness below crude, and namely because I think that as crude continues higher, that's only going to be a negative for the economy, really. And yes, crude does show growth. If crude prices are rising, it's because of increasing quote unquote demand in other areas. But at the same time, rising crude prices definitely have a negative effect. So it's going to be in this area for a long time, which makes it a good trading vehicle for those who are option traders that want to sell puts and calls above and below crude. So that's just what I wanted to cover tonight. As far as where I think the market could be heading in the next couple days, like I said, I think it's going to be pretty quiet until we head into really January. After that, I think that a retest of 1230 is almost a sure thing here. This Fibonacci line right at 1230 also coincides with this high back in November. I think the market's definitely going to come down here and retest that. From there, we'll obviously have to take it one step at a time. As always, happy trading.